gold broke out, as got above that, 4 tries at 2100 or wherever it was, broke out and had a nice run, and then has, consolidated for a couple months at a high level. And I think it's ready to break out again, or get out of that consolidation. I think the next run is probably going to be right to 3,000. I think certainly poor man's gold is a big part of it, but it also is a metal that's in strong demand and not very good supply. And as you know, I mean, it's not an easy. Neither gold or silver is easy to find anymore.
The gold market may be hovering below $2,350. But this hasn't stopped prices from setting new records. As we close out the second quarter, gold has achieved a new record quarterly closing price for the third consecutive quarter. Gold has shown remarkable resilience and growth recently, closing the week at $2,336 per ounce, marking a more than 5% increase from the first quarter's end. Year on year, gold prices have surged impressively by 21% since the conclusion of the second quarter in 2023. This upward trend in gold prices has caused many commodity analysts to be highly bullish. Gold has solid fundamental macroeconomic support, and the long-term chart clearly shows an upward trajectory. Notable analyst David Hunter points out that technically, gold has already surpassed previous resistance levels, breaking through the $2,100 mark after several attempts. It has had a solid run and has since consolidated at high levels, setting the stage for another breakout. David predicts the next upward movement could propel gold prices toward $3,000. One reason is the expectation that U.S. interest rates may decline more swiftly than in other regions. Whether driven by Federal Reserve policies or a rapidly decelerating economy, a weaker dollar will undoubtedly benefit gold significantly. Although seemingly counterintuitive, lower interest rates tend to bolster gold prices. Notably, central banks in China and Russia have been significantly bolstering their gold reserves, which have accounted for over 80% of net central bank gold demand reported to the International Monetary Fund since 2004. This accumulation is seen as a potential strategy to underpin their currencies, further contributing to the demand for gold. Silver, often seen as the poor man's gold, experienced a 1.37% decline last week, but managed to secure a third consecutive quarterly gain. Despite its price volatility, David points out that silver has strong demand fundamentals and limited supply, making it increasingly valuable. We will present clips from David Hunter's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I really believe, and it hasn't come to fruition yet, but I really believe we're staring at a very weak dollar ahead. It's hung in here. It started to break, I don't know when that was, a year ago, and then turned around and had this very long counter-trend rally where it's, gone up, come down some, and gone up again. I really think we have a weak dollar ahead. The problem is Japan's been stubborn in terms of changing their policy, but I think it's a matter of time for them. I mean, they're defying logic in terms of printing money like crazy and being able to keep interest rates close to zero. That's just not, we saw what happened here in 2022. When it breaks fast. And I think Japan's very close to a reversal in the yen. So not by choice, but I think rates are going to start pushing up there. My read of the euro is that the euro is going to rally. Canadian dollar, Australian dollar look poised for rally. So I think the dollar is going to come under pressure. Part of it is going to be, I think, that our interest rates come down faster than some other places. Whether it's Fed induced or whether it's just our economy is going to start decelerating pretty fast. I'm not sure yet, but I think that's all playing into, weak dollar obviously will help gold quite a bit. Lower interest rates, I think, may seem somewhat opposite to intuition, but I think lower rates helps gold. So I think you got both of those coming here. And at the same time, you still do have plenty of things around the world to get those that want to look at gold as a safety or a place to run. You got the geopolitics out there. that is going to add to that. You've got central banks, particularly China and Russia, buying up gold, looking to back their currencies perhaps. So you've got I think there are a lot of cross currents out there that are going to help gold, but more than anything else, technically, gold broke out, as got above that, 4 tries at 2100 or wherever it was, broke out and had a nice run, and then has consolidated for a couple months at a high level. And I think it's ready to break out again, or get out of that consolidation. I think the next run is probably going to be right to 3,000. So I think both technically and fundamentally, it's got support here. And there's been in both gold and silver, you've had very little institutional sponsorship, and if they start performing here, they're pretty thin markets, or not very big markets, particularly on the minor side. That if institutions decide they need to have 5% of that in their portfolio, and they start copying one another, it doesn't take much to drive these prices up. Poor man's gold is a big part of it, but it also is a metal that's in strong demand and not very good supply. And as you know, I mean, it's not an easy, neither gold or silver is easy to find anymore. So, once you start seeing that tight supply demand situation, it's a long process before you can get that supply worked out. So, I think it's got both fundamentals going forward and just the fact that it is poor man's gold.
The U.S. national debt is spiraling upwards at an alarming rate despite mounting criticisms over extensive government spending. This rapid accumulation of debt carries profound implications for the economy. To manage this colossal burden, policymakers are leaning heavily on historically low interest rates, potentially driving them towards near-zero levels through aggressive debt monetization efforts shortly. While this strategy may appear viable initially, it poses significant risks should inflation surge as anticipated. In such a scenario, interest rates could surge to unprecedented heights, potentially soaring to between 15% and 20% for both short-term treasury bills and long-term bonds. David asserts that the implications of such a trajectory are staggering, posing a severe threat to global economic stability. The sheer scale of debt accumulation coupled with unsustainable interest rates could trigger a financial crisis of unprecedented magnitude. This could severely impair the functioning of governments and economies worldwide, raising serious doubts about the long-term sustainability of current economic policies. Addressing these challenges will require urgent and sustainable fiscal measures to mitigate risks and ensure economic resilience in the face of potential catastrophes.
We are able to have a recession, not just a soft landing, a recession, but it doesn't turn into a crisis like we had in 2008-9, and it doesn't. What I keep saying is we've got that 320 trillion in debt, and we've got quadrillions in notional value of derivatives, which is leverage on markets or leverage on securities. Those are two forms of leverage, debt and derivatives, that are at levels that are way beyond anything we've ever seen before, even way beyond 2008-9. If we get a slowdown that turns into a recession, my assumption is what that leverage does is it really breaks things. It exacerbates whatever it is. That's why I'm calling for a bust, is that if for some, in some way we're able to skate through that and have a more normalized recession, then I think Trump's policies are obviously very much more what we want to see. I think you can lower taxes, control regulation, and all of a sudden economies can be efficient again, and you can generate a lot higher GDP, et cetera. So I think that would be the hopeful side of it. I think it's a low probability, and it's not because I think Trump's wrong. It's because I think the bust happens no matter who's president in their first year. And neither one's going to have any ability to control that. It basically, we got to save the system. Here's what you got to do. And once you get into that massive ramp up in both money, monetary expansion, and fiscal expansion to save the system, or it becomes not 34 trillion in debt, but probably double that. Because if I'm talking, or almost double that, if I'm talking about 20 trillion in money, you'll see a similar amount of new debt coming out because they'll be coming up with any program they can to kind of goose the system. So it's, we're at, let's say, 320 now in global debt. I suspect by the time we get to the end of the decade, most of it happening in the first part of the next cycle or in the bust and the year after, I think you could see global debt up closer to 450 or 500 trillion. So if 320 is off the rails, what's 500? And again, it'll then have to be serviced at rates that are, because I think next year you could see a 0% 10-year because of the monetization of the debt. They'll be buying up every bond they can. So you could have for a little while, they'll be thinking, well, we can service this because rates are low. We'll keep rates low. Once inflation ramps up, it's going to ramp up very fast. All of a sudden, like I said, you're going to be looking at 15 and 20%, not only T-bills, but long bonds. And there's just nothing they can do to service debt. And the debt's going to be double what it is now. So I just don't know how that equation leads to anything but a disaster.
While gold may experience further downward movement in the short term, the broader trend resists significant shifts. Despite its enduring strong fundamentals over the long term, the market lacks a clear catalyst that could ignite a substantial rally toward new all-time highs. Investor attention remains fixed on gold's opportunity costs, particularly as the Federal Reserve persists with its assertive monetary policy stance. Share your thoughts on David's prediction in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.